Okay, good morning, everyone. It's Sean Sandilands from Pulse Markets here. We're doing an update this morning with John Ford and Richard Morrow from Lowell Funds Management. I'd just like to say good morning to everybody and thank you for coming. Today, what we're going to do is it's a two-part presentation. Initially, we'll get an update of how the market's been going from John Ford. The LIC, the Lowell Funds Management, has been performing quite well. And we'd just like to get a bit of an update of what's happening in the resource space. So John will give us a brief outline of what's been going on. Then we've had some questions that have come through from investors in the last week or so, which we think are quite relevant to the current market conditions, and who better to ask than John, who's performed so well. So what I'd like to do is to stop hearing from me. I'd like to introduce John Forward. And John, I'll hand it over to you to give a quick update on the resource space, please.
Thanks very much, Sean. Thanks for your time this morning and having Lowell back on to your segment. And also thanks to, we've got Richard Morrow from our investment committee and the director of Lowell Funds Management on the line as well, who might be able to chip in with anything that I miss. So while that's coming up, Lowell is and I see quite a few familiar names on the call, so thanks very much everyone for participating. Lowell is a long only, no gearing fund, just focused on the junior resources sector. The management company's been running the fund for 17 years now. It was an unlisted unit trust for a long time. Now it's a listed unit trust. And we listed it back in March 2018, so just over 3 years ago. We're focused on the junior sector. We just we focus across the commodity space, everything from gold and other precious metals right through to oil and gas. So fairly broad in the commodities sense, but very focused in terms of the broader investment market. As a trust, 100% of taxable profits are distributed, and today is actually the day when the latest distribution is being paid. So that's a 15-cent distribution on current unit price is about $1.40. So yeah, around the 10% level, which demonstrates the year that we had to 30 June 2021. We take significant risk in terms of the investment profile, but we look to earn get the significant or the potential for significant returns. And when we make those returns, we'll be taking profits and distributing the capital gain back to our unit holders. So we've got a dual investment process. Firstly, the overlay is top down in terms of the macroeconomic environment, which has been super important, but also super difficult to forecast, particularly since COVID has hit and the really wild gyrations in the market. And then we have a bottom-up approach, which is really where I come into the picture, with a technical geological background, looking at individual stocks, in terms of which particular commodities we select which particular commodities we want to get involved in, and then we look at a weighting towards individual stocks. And that's based on numerous criteria, a couple of prime ones obviously being the project and the management. That's the stage where we look to invest. We look to get in pretty early and take some significant resource risk in terms of trying to judge early on in an exploration program when a particular deposit or discovery may be heading towards something that's significant in terms of economic potential. and we'll take that risk pretty early. We'll allocate funds to things that we like, even though there may not be too much indication of an economic discovery, but we'll try and look at the tea leaves on the exploration indicators and take a position. Sometimes that might be quite modest. Certainly junior companies are capital hungry and fairly regularly need to return to the market for additional equity funds. But we always try and keep significant powder dry so that when companies that we like do need to come back to the market and raise more money, then if they have hit their investment milestones, we're able to keep up the running, assist them with additional funding. So this just sort of exemplifies what I've just been talking about in terms of our focus. This is our current portfolio in terms of the stage of project that we're invested in. So a little bit, a bit over 10% in grassroots projects, i.e. projects that don't even have a JORC resource yet. But the vast bulk of our funds are in the category of companies that've got a resource. It might be quite modest, but are still exploring and looking to expand that resource. Then our focus generally lessens, and we usually look to exit around the when companies get towards development or commissioning. We do have a bit of production exposure. That's mainly on the oil and gas side, where it's easier for junior companies to perhaps have a joint venture interest in a producing asset, while at the same time having exposure to exploration upside. And our cash position usually is somewhere between 5 and 10%. That's the people involved. Myself, I've got a geological background, and in the distant past, I qualified as a lawyer. Richard Morrow, who's on the call, is very experienced in the resources sector. A very experienced stockbroker with value ordinate, or however they are termed these days, Richard. And also is probably main claim to fame is chairman of the fantastic Melbourne Mining Club. Steve Mitchell is the chairman of the management company. He's got a background on the oil and gas side with Malopo Oil and Gas, which he took to some great heights during the second to last coal seam gas boom. And then Stu Baker has got a very, very deep experience in Australian oil and gas analysis and a technical background as well. So just getting on to the performance, we benchmark ourselves against the ASX Small Resources Index, and over all those periods that you can see there from 12 months to 10 years, we've significantly outperformed that benchmark, particularly over the longer term, doing nearly 13% per annum. The benchmark actually went backwards over that period, and probably the strongest period is the last 2 years, particularly encompassing the COVID period, where we've had some fantastic 2-year performance. Just sort of summing that up again with some other benchmarks there, including the ASX Resources 300 Index and ASX 200 Index, which we've also outperformed. So I think we were ranked the top ranked fund in terms of listed funds by the Risk Return Metrics Group in June for the I think there's about 100 funds that research covers, and the Lowell Resources Fund was the top ranked fund in June this year. That chart on the right just shows you how we performed against our benchmark over sort of the last best part of the last 2 years. We're still a small fund. The net assets under management are about 48 million. We've got about 700 unit holders. As I said, we are listed on the ASX, and we're trading at a discount to our NAV. That's about a bit over a 10% discount in terms of the ASX traded price to the underlying NAV. So in terms of our exposure to commodities, which we put out the end of every month. So the end of last month, basically 50% in gold, and then the next biggest exposures are base metals, which is copper, lead, and zinc. And we carve out from that nickel, which is a significant exposure for us and pretty important and has performed pretty well. And then oil and gas, that sector, as perhaps we'll touch on a bit later, has been really in the doldrums and not getting a lot of love. But we think that there's some important performance to come from that sector. And then we do have a range of more minor commodities in the portfolio, which have the potential to really perform. But the more conventional commodities are the ones that we're fairly heavily exposed to. In terms of slicing and dicing the portfolio a little bit more, we're dominantly exposed to the ASX. Nearly 80% of our investments are listed by value on the ASX, but we do have some exposure to other markets. We've got about 6% listed on the Toronto Stock Exchanges, the Toronto Exchange or the Canadian Stock Exchange. We can invest in unlisted stocks, and that's been has been for some of those unlisted investments, very good performance for us. And then at the moment, we're about 8% cash. In terms of geography, probably a bit of a similar story. Half of the portfolio is exposed to Australian projects. Then we've got some substantial exposure to slightly higher risk jurisdictions such as Africa, and West African gold is very important for the portfolio and has performed really well. And also Latin America, where we've got some important nickel and copper exposure in Latin America, but mainly through ASX listed stocks. We put this out every month as well in terms of our biggest holdings, and as mentioned, West African gold is very important for us. Predictive discovery makes up nearly 12% of the portfolio at the moment, and that's really because of its performance and our long-term belief and holding in that company, which 18 months ago made a fantastic discovery in Guinea, in West Africa, gold discovery called Northeast Bankan, and we're very interested to see what the announcements, which should be due out by the end of the quarter, September, in terms of initial mineral resource and in terms of initial metallurgical work on that discovery come out at. But that share price has gone from they did a raising which we participated in at 0.5 cent back in, I think it was February last year, and it's now trading around 13 or 14 cents. So great performer. The others there, you can see quite a number of gold stocks with some good exposure to Western Australian gold, and some reasonable exposure to nickel, which is Centaurus there in South America and Brazil, and that's nickel sulfide. Also another nickel sulfide project, Talon Metals in Minnesota in North America, which is a fantastic looking project in joint venture with Rio Tinto. Just a couple of other stocks that have performed, which have performed pretty well. I mentioned Predictive Discovery, but Australian Rare Earths is a more recent investment for us, where we came in at IPO level at 30 cents only last month. It looked like fantastic value at the time, and that's subsequently borne out by the share price nearly quadrupling over the last 2 months. And a very interesting project in South Australia, a rare earths project, which looks like it has some excellent metallurgical characteristics, which is probably the key to its value. I've mentioned Centaurus Metals in Brazil, which has got 500,000 tons of contained nickel sulfide in mainly open pittable depths, and the metallurgy looks good there too. So that's a pretty exciting project in the current nickel market. And then Caravel Minerals, it's a very large, low grade, but well situated in Western Australia copper project, and we invested there at about 4 cents a share, and it's gone up nearly 10 times in the last 18 months. Really, thesis there was it's leverage to the copper price, and the copper price has performed very well, even though it's come off a little in the last few months. But if you plug in current copper prices to that project scoping study, you get an NPV which is well north of $1 billion, compared to market cap of about, I think it's a bit over 100 million at the moment. Just another example. Finally, we've shown this one before, but De Grey is an important holding in our portfolio. We invested because we really like the huge tract of ground they had covering the Mallina shear zone up in the Pilbara in WA, and stuck to our knitting over a number of years and kept on investing even as the share price drifted down, and then made a fantastic discovery in December 2019, and the share price has really performed fantastically since then, and it's probably one of the biggest discoveries globally that we've seen in the last few years. Enough for the moment. Sean, do you want to turn it over to some questions?
That was great. Thanks, John. That was really informative, and congratulations on the job well done. You've really outperformed everything, which is great. And being number one is a terrific result. Not many people can claim that.
Yeah, got to keep working hard on it though.
That's why it's good for my clients to get exposure to well as well. I can't be looking at every stock all the time, so it's good to have your team helping our investors at the same time. Now, having said that, we've got some questions that I'd like you guys to go over for me, please. We've just looked at the allocations of the fund, and we have noticed that you are heavily in gold, heavily invested in gold companies. Can you just elaborate as to why you've chosen that, please?
Look, there's a number of reasons which are, some are specific to the junior resources market, and some are general in terms of the drivers for the gold price. Now, we've seen gold perform, really well over the medium term, but in terms of junior resources, it's a commodity which is relatively easy to explore for. And it's a commodity which is relatively within the capital capabilities of junior companies. We're not talking about having to build huge amounts of infrastructure for what could be a remote gold mine. If we take Predictive Discovery, for example, they're in the back blocks of Guinea, which is not renowned for being endowed with infrastructure. But if they look to build a mine there, they could take a guess, but a few $100 million would be the capital cost potentially. And I don't know anything about the what the capital numbers would be there, but that's not out of the question. So it's possible for junior companies to explore and develop gold mines, within their capabilities. I think also gold is well understood by the market. It's not something that requires a lot of research to understand, how you market and sell gold. The price is readily disclosable. Gold is gold. And partly for that reason, gold companies can end up trading at a premium to their underlying NPVs when the market is right, or at least trade, in line with their underlying NPVs. So you're not suffering a discount. Finally, I think gold at the moment, we really like the fundamentals. Boyd, there's a couple of slides there. I think we threw up the slide on the real interest rates. They've trended negative and are pretty much at all-time lows. And that is, you can see there, since COVID, they've gone negative over the last 18 months, and they're down at sort of around negative 1% US real interest rates. So that's really permissive for a strong gold price. So there's a number of reasons there that we've got such a strong allocation to gold.
And if I could jump in there as well, John, just the ABS data out yesterday showed for the June quarter, gold exploration was about $400 million for the quarter across Australia, which is equal to all that spent for base metals and coal. So, you've got to follow where the money is going. Australia is the place to find gold. It's not easy to find it, don't get us wrong, but there's a heck of a lot of money chasing it, and the more you spend, the higher the likelihood of you go finding something, and the numbers speak for themselves. Yeah, thanks, John.
Yeah, just that slide there, I think reiterates your point, Richard, that this is the ASX resources listings for the first half of this year, and there's been a lot more IPOs. I think there's has been north of 50 IPOs in the resources space just in 6 months to the middle of this year. But most of those have been in gold. Over nearly half of them, 25 of those IPOs were gold IPOs. So that's where the money's going at the moment.
Right, thank you. Last year in April, when everything was at its worst with COVID, you were one of the few that said you saw a lot of good value and you liked the outlook. What were the indicators that you saw back then?
Look, I think back then we thought that the outcome could be similar to what we saw in the GFC in 2008, which was a really sharp shock to the financial system, and pretty much all assets apart from the US dollar, plummeted. And in the GFC, the post GFC, the junior resources sector actually performed really well. It tripled. So that was something that we thought might happen. And then sort of on a more micro level, things like while most commodities got hit pretty hard, things like oil got hit incredibly hard, and the price actually went negative there for a little bit. So and for miners, the energy input is typically about 25% of their operating cost. So we saw that operating margin, when metal prices start to recover, we saw that operating margin really start to open up, and that's been borne out subsequently. I think we've got some slides there about the profitability of gold miners and the profitability of iron ore miners in particular. You can see there, in the last quarter, the mid-tier gold miners in Australia have been, or ASX listed gold miners have been making a 36% margin, which is really handsome in terms of the cash that's been accumulated and paid out to shareholders.
Yeah, and if I could jump in there too, and if you like, I mean, a lot of that cash is just building up there on balance sheets, and at the same time as these producers are depleting their reserves. One of our key themes that we're working on is that we'll see takeovers in that space, rationalisation. I mean, rather than waiting around 18 months to build a mill, there's a lot of hungry mills out there, and people, when you're making revenue, the top line at 2,400 Aussie an ounce, you can pay 100, you can pay $200 an ounce to in a takeover to especially well located bit of the ground over in Western Australia. You can pay 200 an ounce and still make a lot of money.
Exactly. In the gold sense, if you're making $800 an ounce on an ounce of gold, and you're potentially buying it for $200 an ounce, that's pretty good business in anyone's language. But that slide that your boy just showed there, in a broader sense, I think the big three miners in Australia have their profit this year was over 60 billion Aussie dollars. And that's flowed into some really big dividends, record dividends, and that those dividends are going into the pockets of shareholders who are wondering what to do with it. And Twiggy Forrest is obviously the biggest beneficiary, and he's just an example this morning, he's upped his bid for a nickel project in Canada. So he's he turned around, got his dividend check yesterday, and turned around and spending it already, and we're expecting to see a lot more of that. Other shareholders, well, they won't be as big as Twiggy, but they'll be looking around to see what other opportunities there are that they can do with their dividend monies.
And then on the flip side, you're seeing the gold companies, they're being nowhere near as generous with their dividends. They're actually squirreling the money, perhaps building up the bank account for to acquire the next project. Even though your finding cost of gold is actually not all that large these days with the success explorers have had. Is to be able to get the certainty of buying ounces in the ground, why not pay a little bit more?
Okay, excellent. We've just got a question from one of the participants. They've asked for comments on critical metals such as nickel and battery metals. Are they hype, or is the shortage/trade war with China real?
Look, I think nickel is one of our favorite commodities. As mentioned, we're not the only ones who really like nickel. We've seen BHP turn around, from wanting to sell its Nickel West complex in WA to investing significant sums in expanding and continuing there. We know that Rio Tinto are very keen on nickel. They're in joint venture with the Talon Metals guys in Minnesota, and instead of taking their joint venture payments in cash, they're wanting to hold on to that and put it into equity in that company. We know that Elon Musk, in terms of of Tesla's requirements for nickel, that's his biggest worry in terms of sourcing nickel. If he hits his forecasts or his predictions in the next 10 years, he's going to need a multiple of the current world nickel production. So on the downside, we did see one of the big Chinese nickel refiners earlier this year come out and say they've got a new process which could produce about 25% of the current world's nickel nickel sulfate from a new process from nickel pig iron. But I think the market sort of digested that now and said, well, nickel ain't nickel. We want green nickel, particularly if this is going into batteries and electric vehicles. Not much point having very energy intensive nickel production. So the market has said, well, probably that process is going to require 3 or 4 times the amount of energy intensity to produce nickel from nickel pig iron as it is to produce from nickel sulfide. So and even if it does produce 25% of the world's demand, that won't be enough to satisfy the forecasts. So we're very positive on nickel in particular.
Okay, thank you. Back to the fund. Has your sector allocation changed recently?
So gold has gone up and down, and that's somewhere between 40 and over 60%. When the gold price really ran late last year, our gold allocation moved with it. But it's around 50% at the moment, which is fairly average. Our nickel exposure has definitely grown, and we like that. Our oil and gas exposure has diminished somewhat, and that's really a function of the market. We think that there's some great fundamentals for gas in Eastern Australia, and we've got a chart of the gas, that one there, just showing gas prices in Victoria. Those gas prices have really started to spike on largely on the back of diminishing production out of Bass Strait, which is the vast majority of gas prices. And that chart there, or those 2 charts there, show that oil and gas has been really the poor cousin in attracting funding for exploration. Oil and gas spending has dropped in half in the last 6 years. By comparison, hard rock, and which is mainly gold with lesser copper and nickel, hard rock exploration funding in Australia has doubled over that period. So, eventually that's, and that is coming home to roost in terms of, hydrocarbon pricing, that, there's just not enough, gas being found and developed in Eastern Australia.
Okay, thank you. Rare earth prices have strengthened. Can you throw a little bit of light on that for us too, please?
Look, I think, the rare earths are completely dominated. The market is completely dominated by China. And everyone's very worried, or the Western world, I should say, is very worried about that market dominance. So even though China has been releasing more rare earths into the global market in the first 6 months of this year, the demand from specialty magnets and electric vehicles in particular is forecast to, I think it's forecast to grow by over 4 times this decade alone. So probably, you've got the 2 things: worries about what China's control of the market will do, and just growth in demand. And so people are really scouting around. The Biden administration's announced a lot of support for domestic rare earth production in the US, and places like Australia are benefiting from that. It's almost a scare, I would think, in terms of potential shortages. And you've seen Lynas Corporation do really well, based off its Australian-based rare earths project at Mount Weld. And as mentioned earlier, new potential projects in Australia, like Australian Rare Earths Project in South Australia, really attracted a lot of attention. So I guess another factor is on the downside. Electric vehicle manufacturers are trying to thrift their use of rare earths, but as I understand it, there's a real limit to the minimum amount of rare earths that are required in an electric vehicle.
And then you've got the impact on the share prices of things like exchange traded funds that are focused in this little niche. And there's probably at the moment the money coming to the front end of the ETFs has to be deployed out the back end, and there's in all probability there's too much money chasing too little opportunity in that space, and hence we've seen the explosion in the share price of people that have made discoveries in that space. It's an exciting area, but I think one for the extremely brave.
Okay, thank you. Going from rare earths to oil, you've said the market's been going sideways for a while. With the impact of the Delta COVID strain, currently, what do you see after that, post-COVID, with oil prices?
Yeah, well, that's a it's a loaded question there, Sean, in terms of post-COVID and when that actually comes. So pretty tricky. What we can say is that I think the emergence of the Delta strain of COVID has spooked the market. We're seeing, we were seeing demand, pick up pretty well. China in particular, now the world's biggest importer of oil, and that demand has started to soften. We've also seen OPEC relax some of its or reinstigate some production that was cut back late last year. So the oil price is currently right now softening somewhat. It's come off from the in the $70 a barrel to the $60 a barrel. So look, in the midterm, while I think COVID persists, we're probably not going to see too much outperformance from oil. In the longer term, as some of those charts we put up a bit earlier show, the investment in oil exploration and to a lesser extent or to some extent development has really there's been a drought in terms of investment in major new oil supply. So I think in the longer term post COVID, we should see oil perform pretty well, because even with the growth in electric vehicles, we are going to see continuing demand for oil. It's not going to go away overnight, that's for sure.
Okay, great. Well, with those charts, I think they sort of resemble what we're talking about gas earlier, with the lack of exploration of gas, the East Coast gas prices going up. Do you see that unwinding at some point and prices going back to where they were previously?
Look,
we're already seeing
gold.
Sorry, John. We're already seeing gas prices in Victoria, in particular, back up to their highs of last of a few years back. There's quite a reasonable pull factor in that from industry, on top of the massive increase in exports out of the East Coast through Gladstone. So we're even starting to see much more focused comment in the media at the moment about importing of gas and regasification of LNG. I mean, it's moving all over the place at the moment. And one of the big things is gas is of course the preferred choice of fuel for electricity generation. So as coal drops off, and the transition fuel for into renewables. So gas and we've got our gas exposure modest at the moment. We own Comet Ridge, which we think's got a lot of potential. But it's hard to find good gas opportunity in Australia, but we're keeping on looking for it. Led by our colleague Stewie Baker, before very, very experienced oil and gas man.
You touched on coal just then, which brings me to another question that someone's asked. how will this affect the price of thermal coal, and what exposure does the portfolio have at the moment?
Well, just to mention, we don't have any, the price for thermal coal has been the best performing, commodity to 30 June over the 12 months. We don't have any exposure to coal, either in terms of coking or thermal. But the demand for coal out of Asia, in particular, is very strong, and we're seeing record prices for Newcastle thermal coal out of Australia.
I mean, also there's a theme that plays through there that we could have the best coal stock in the world, and you look at the cash flow multiples that something like a Whitehaven's trading on at the moment. You'd have the best coal company and the best fundamentals in the world, but there ain't going to be anyone there wanting to buy it, and buy the equity. So we could have the best story in the world, but no one wants to listen, and that appears to be the way of it at the moment.
Okay, thank you. Switching commodities, because I am cautious of time. Tin, why has that gone up, and what exposure have you got or added recently?
Yeah, tin price is at record, or has been at record levels recently, and that's due to a number of factors. Demand for personal electronics and the requirement for tin in solder in the semiconductor industry. So there's definitely a demand pull, and then there's been some impacts which may or may not be short term on supply. The coup and the situation in Myanmar, which has been supplying substantial amounts of tin ores into southern China. And then in southern China, we've seen there's been scares about the COVID Delta strain potentially requiring shutdowns of tin refineries in the union. And also there's been power shortages, I understand, due to droughts, I think, in that same area, which is a big producer. A number of factors in play there driving tin inventories, visible tin inventories to very low levels of a week or two's supply. So look, tin is a bit of a tricky one in the junior resources space. I guess the other longer term factor is there's been no new tin mines developed, at least by Western companies, for many years, and it is hard to drill out these things. They can be quite nuggety, so putting reserves around them. So finding a tin project which has potential to get developed is quite challenging. We've got some exposure to tin. We've got an investment in a company down in Tasmania, Flynn Gold, which has got tin projects. But it's certainly not like gold, where you see a lot of new gold developments come online, sponsored by junior companies. Okay,
thank you. Two questions here, which I think I'll meld into one. We touched on nickel earlier with the price going up, and you mentioned electric vehicles with Tesla. That brings us to lithium. Have we missed the boat if we're not invested in lithium at the moment, or are there still opportunities available to us?
Look, the fund is, monitors lithium very closely. We've had some fantastic investments in lithium. Most recently, Liontown Resources with their Kathleen Valley lithium project in WA, a real world-class project. Before that, we did have a wonderful experience with Kidman Resources, also focused in WA. But it has become, the lithium price has rebounded very strongly after a couple of years of oversupply. And as a result, the lithium equities have really responded. And it has become quite tricky to find deep value in the lithium space, even in the junior explorers. So we're monitoring a couple of opportunities pretty closely, but haven't found a preferred entry point as yet. Long term, the fundamentals of lithium, look good. We've seen Rio give the green light to its Jadar project in Serbia, which will make it the biggest lithium supplier in Europe. And in the shorter term, you're seeing strikes at in Chile, at the world's biggest lithium producer at Albemarle, and that their lithium brine projects, which are starting to get a bit of a question mark over their environmental credentials and the usage of water. So look, there's a lot of moving parts there. There's 3 new lithium hydroxide refineries coming online over the next 6 to 9 months, a couple in WA and one in Japan. So there'll be some more production there. So there's a lot of moving parts. Overlaid on that is the demand. Lithium batteries are definitely the incumbent, and for the midterm, what most electric vehicles are going to use. But every month it seems there's new chemistries that are researched and coming out with technical success on new types of chemistry, which may or may not replace the lithium-ion battery.
Okay, that's great. Thank you. Going to Chile now, copper and Chile. There's been a little bit of unrest in Chile, as people may have seen in the news. Is there a global shock risk from that, with people pulling investments?
I mean, macro events in the metals markets, particularly LME, subject to a lot of speculation and rumor and innuendo. Probably, something. There was a time in Chile where you could almost set your watch by the last lot of industrial problems. And metal markets, as they are rife with these sorts of stories. So, yeah, I guess we're going to see. It's just one of the many impacts on on metal markets. Is that political question? You don't take your eye off it, but I don't think you make as much of a meal out of it as that would suggest. John, would you agree with that?
Yeah, it's been interesting. Chile is the world's biggest copper producer, followed by Peru, and both of those countries have to the left in terms of government changes, and both there's been talk of major significant imposts on miners and copper miners in particular from both of those countries. But if you look at the equity markets, which should be pricing in those factors, they really haven't. They've sort of gone along without too much of a bump, and accommodated that. So I think, Richard, you're right that it's not plain sailing, but it's not unusual conditions. We've got a significant investment in Hot Chile, which is drilling out and exploring a couple of porphyry copper projects in Chile, north of Santiago, and that share price has actually performed very well of late. So maybe the equity market is telling us that we shouldn't be too worried about those political factors in those countries, but we'll wait and see.
A bigger issue for me is the technical difficulties over there and the grade of ore being mined. I mean, it's just falling away. You've got to move a whole lot more dirt to get the same result. Your costs push up. It's copper isn't exactly what it used to be for Chile in particular.
Okay, great. One that I'm actually interested in at the moment, which I've been doing some research on, I'll mention the stock in a report at another time. Colin, is there anything interesting that you guys can comment on there? Has the horse bolted, or do you just still see some strength in the commodity?
Yeah, look, that's a real boutique market sector, and it's really all about the quality of the clay. So the fund in the past has done really well out of Andromeda Metals, which has got this halloysite clay project in South Australia, which it does is a really high quality clay with multiple uses. One potential one is to suck carbon dioxide out of the atmosphere. So look, it's really horses for courses there. That the individual niche markets are fantastic, and you can command some amazing prices for your product if you've got the highest quality product.
Okay, thank you. We touched earlier on in the presentation, we looked at negative interest rates, which in turn should push up inflation. How is that going to be a good thing for commodities and the portfolio?
Would definitely agree that inflation is all around us. We're seeing inflation in shipping costs. We're seeing inflations in used cars and real estate and timber and all sorts of things. So I think, and that feeds into the real interest rates. So, nominal interest rates, minus, if they're not keeping pace with inflation, then, real interest rates are negative. And the cost of holding things like gold and other hard assets is therefore very low, and there's no opportunity cost to do that. So, yeah, look, I think, inflation in general, if interest rates don't keep pace with it, is pretty positive for commodities.
And the preferred narrative around the world at the moment, especially amongst central bankers, is that the inflationary pressures are transitory. John and I are old enough to remember inflation back in the 1980s, and very, very hard beast to control once it gets away from you. At the moment, the world seems to have full confidence in the ability of central banks to wave their magic wand and control inflation without resorting to the age-old methods of lifting interest rates and constraining money supply. But we're getting close to the period where another few months of this transitory inflation, and someone's going to have to do something serious about it. Now, yes, inflation's a two-edged sword for gold, because when it breaks out, interest rates go up, those real yields turn from negative to positive, and impact on the valuation of a non-yielding asset like gold. So sure, I'd say it's a two-edged sword. Initially good, and then when as interest rates pick up, if they do, I don't see how the world can afford to have higher interest rates, because America won't be able to make the coupon on those unless they run those printing presses a lot harder. It's a dangerous time, and it's feeding into support for the price of not only hard assets like the precious metals, but also for inputs, like copper, definitely.
Okay, thank you. Just let everyone know, we've got about 10 to 15 minutes worth of questions and answers left. We will be recording this and sending it out. I'd just like to make a quick note. We didn't do the disclaimer at the beginning. This is not financial advice. This is just an update from Lowell and myself as to what's happening in the markets. please make your own investment decisions. Back to oil quickly. I should have asked this earlier. I'm sorry to jump around. BHP getting out of oil and going into fertilizer. That was a huge decision by them, which wasn't really looked on that favourably at the time. The stock fell over in the next 2 days of that announcement. What do you think that could do to the smaller end of the market? Is there any flow-on effects that could provide some, I guess, some options for you guys to take advantage of?
Yeah, look, I think, that's just perhaps symptomatic of, the capital allocation or lack thereof that's going into hydrocarbons. And I think in the big picture, that will potentially drive, supply and demand imbalance in favour of higher prices for oil. Generally when you see those big transactions happen, that there are assets that fall off the edge of the table that are too small. Woodside now moves into being, I think, one of the top 10 oil companies or hydrocarbon companies in the world. So there may be assets in its portfolio that it wants to get rid of, and they will be hoovered up by smaller companies, we would expect.
Okay, just on the fertilizer topic, we've just had an investor ask, do you have a view on Lead Creek Energy at the moment?
Look, it's not one we're following closely. I have to say, certainly looked at it in the past, so yeah, I wouldn't want to, make a up-to-date informed comment there.
Okay, that's great. If anyone wants any information on that, feel free to contact me after the event. I do follow that one closely. Okay, now getting to the tail end. With the performance of Lowell, you do pay out substantial dividends, which is good. How big could your fund get? Because obviously with that #1 rating and with the outperformance that you've achieved, you're obviously coming under the microscope of financial planners and other investors looking to diversify the management in the smaller cap marketplace. Could you double your size, triple it? I mean, how big can your fund be while still being nimble, not to affect prices, and still be able to get liquidity? What do you think is the sweet spot for the size of the Well Investment Fund?
Oh yeah, look, certainly we'd like to grow it. We've grown from, at the time of listing, about 20 million NAV to around 50, just under 50 odd at the moment. Certainly there's the capacity to double it or get to something more than $100 million under management. At the junior end of the sector, what we like to do is be nimble and be able to get in and get out reasonably easily. So that means generally staying under 5% of any particular stock, which on the ASX means we're below the disclosure threshold. And if we want to get out in a reasonable market, we can do that without upsetting the market for a particular stock in general. So on the other hand, a 5% or less holding in a particular stock can still move the needle. If you've got say you've got 5% of a $50 or $100 million stock, and that has the mythical 10 bagger to it, then you really got some fantastic performance. You're seeing some really big increases in your NAV as a result of just one stock, which you couldn't get so much if you were a multi-billion dollar fund. So we're certainly not wanting to be in that level, but at the junior end of the market, there's a huge number of opportunities to choose from. I like to say that West Perth is like the Silicon Valley of the exploration sector. It's got the absolutely world-class explorationists and mine developers in the junior sector there, and it's a hotbed of activity. So and there's 700 odd resources stock listed just on the ASX. There's a couple of thousand on the Toronto Stock Exchange. Most of those are very small companies, and that's where we operate. So we've got abundance of riches in terms of the opportunities before us.
Okay. With COVID, this question keeps coming up from everybody I speak to, and I'm assuming you've got the same. I've got a couple of questions to finish on here. I noticed in the Sydney Morning Herald this morning, we're in a recession. It just hasn't really been documented properly yet. What will the market do with this? Will there be a fall in global demand on the back of this recession for commodities?
Well, I dispute that. If you look at we're a very focused side of the economy and resources, very much on the coattails of China, which is growing at sort of 6-7% at the moment. Yes, there are certain parts of the industry, say education, travel, that are under stress at the moment, and got a lot of capacity in there. But the resources, I mean, look, COVID's not having any impact on exploration. Generally, it's a vital, it's rated as a vital industry, and people can get out there in the field, and the field season in a lot of Australia, or East Coast anyway, is really just about to kick-start. So look, to the extent that COVID can slow down China, and let's face it, China, it's where it started, and it's been going there for 18 months. They're still growing at 6%. There's a lot of pull factor from the rest of the world, which is using China as its manufacturing base. There's I just sort of dispute the basis of that assessment. Resources more affixed to the global scenario, and the global scenario has been driven by China, and maybe to a lesser extent, in as far as oil and gas is concerned, maybe India and other parts of Asia. So that's how I would see it.
Awesome, that's great. Okay, we're going to tidy up on a last question now. So I want you to get your crystal balls out and give us a prediction for the next 6 to 12 months, maybe 2 years, where you see the world going and where you think you'd like to be invested. Obviously, you're 42% in gold at the moment, so that gives us a pretty good indication as to where you want to be. I thought we'd lost you then. You fell off the chair.
Yeah, that looks dangerous.
You've got a good position in gold, so clearly you've got an idea that's where you want to be at the moment. But if you could just give the participants a little bit of an insight, and then we'll tidy things up, please.
John?
Yeah, look, I think, we're still very much in that bad news is good news situation. If there's some bad economic news, particularly out of the US, then that will, result in further money printing, further loose monetary conditions, and that will result in good for our sector in particular, the junior resources sector, where it's perhaps the more speculative end of the sector, which attracts capital when loose money conditions are around. So I think we're seeing that persist. Overlaid on that, in terms of perhaps more specific sectors, copper is something that the thematic there is not going to go away in terms of electrification of the globe. And then, perhaps more specifically, we're seeing stimulus out of the US, moving through, the Congress and the Senate, $1 trillion package there, and another, multi-trillion-dollar package potentially following close behind it. So we'll see, infrastructure spend and demand for critical metals supported by that. So and those factors, in particular, that infrastructure, that's sort of independent of the end of COVID, I would say.
And also, if you look at where we're focused, and if I peer into my crystal ball there before it rolled off the table, you've got record investment spending, in Australia. It's so well funded at the moment, probably too well funded, but the more you throw at exploration, the more you're going to find, particularly undercover, and the technology that the industry is using aggressively these days is just feeding into that exploration activity. And let's face it, the more you explore, the more you're going to find. It's a numbers game, and we've got a very highly mineralized continent. There's other places of the world as well. This technology is really peering through those, through desert cover, through other harder cover. There's more there to be found, and we've got the tools to find it with. So we're looking forward to more and more exploration and more discovery, and watching that get recognised. That's one of the great things about the market over the last couple of years, is that a good discovery is getting recognised. You look at what De Grey's done, you look at what Predictive's done. You go out there and your technology finds something, you develop it, you get the reward. You couldn't have said that for, say, the 3 years previous to that. So we're very, very optimistic about the explorers by the amount of cash they've got and the technology they're using. Would you agree with that, John?
Yeah, exactly. And that little chart that Boyd just threw up, the juniors are the ones who have been, over the last 20 years, they're the ones by far and away who've been making the Australian mineral discoveries. So if you want exposure to discovery success, it's the juniors that you need to be invested in.
Okay, guys, I'd just like to thank you very much for coming, and everyone who could attend for attending today. I think that's been very, very helpful in the current climate. I really appreciate you giving us a little bit of an insight into how you're running things. And again, congratulations on the terrific results over the last 10 years. You're not a one-hit wonder. The 10 years really show that the outperformance is something which can keep going. And I look forward to watching this space and watching the fund grow. Congratulations.
Thanks, Sean.
Thanks, Sean.
And thank you to yourself and to Pulse for hosting us today. And, please follow us on Twitter, on LinkedIn, or go to our website and our ASX announcements. Thank you very much today, mate. John?
Yeah, no, look, a pleasure as always, Sean, and look forward to doing it in person, hopefully in the not too distant future.
Okay, guys. Well, everyone, this is, as I said, this has not been financial advice. This is just an update with the terrific performance that the Lowell Fund has done, so you can meet the fund managers. Any questions, please feel free to email them through, but this will be up online in the next 2 or 3 days if you want to review it or refer it to other investors. But what I'd like to do now is to call the meeting to a close, and thank you very much for attending.
Thank you. Thanks very much.
Thanks, Sean.
Thanks.
Cheers.